Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at super microcomputer. And looking at the latest market data, this is undeniably the main story right now. I mean, the stock just experienced a violent 27.98% crash.
Wow.
Yeah, straight down to $29.27. And this was right after the announcement of a massive $7 billion equity financing transaction. But, beneath that really terrifying headline, there's a staggering $39 billion backlog of AI server orders. So the mission today is to figure out if this is like a fundamentally broken company or just a massive opportunity.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into the actual mechanics of the stock, we should mention a useful tool. If you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos is this TradingView indicator suite that shows visual buy and sell chart alerts, support and resistance zones.
Right, super visual.
Exactly. It works across stocks, Forex, crypto, and more. But remember, it is an educational tool only. It's not financial advice, and it does not guarantee profits. The link is below in the description, and it is an affiliate link, so we may earn a commission at no extra cost to you.
All right, so let's move into the wealth building context here because, every long-term investor is staring at that $29 price tag, and they're asking, is this a falling knife? Like, is it going to keep punishing anyone who tries to catch it, or is this a rare entry point?
It's a really fair question.
Right, because honestly, it's hard not to be skeptical. The immense volatility we're seeing, it just makes risk management almost impossible. You don't lose 28% in one day in a normal market correction. That looks like a structural failure.
Well, yeah, and that skepticism makes total sense. And it's exactly why we need to frame how supermicrocomputer actually fits into a portfolio. This fits a very speculative, high-growth infrastructure profile.
Not a safe haven dividend stock, in other words.
But no, definitely not. What we are witnessing right now on the tape is this incredibly painful transition. They're going from being a momentum-driven darling where the price just went up every day purely on AI hype to a capital-heavy, value-backed infrastructure builder.
But a pure infrastructure builder shouldn't be wiping out nearly 30% of its value on a single press release, right?
True, but the volatility is fundamentally tied to the physics of their massive growth. The sheer scale of the demand they are trying to meet is just straining their balance sheet to its absolute breaking point.
Oh, so it's a symptom of growing too fast?
Exactly. To understand why the market panicked, you have to look under the hood at the core business mechanics, which, leads us right into the fundamentals.
Yeah, let's look at the fundamentals. Because if they are this massive infrastructure powerhouse, how do they suddenly find themselves needing $7 billion just to keep the lights on?
Right, so it all comes down to their primary moat, which is speed to market. They use this proprietary architecture. They call it data center building block solutions.
Okay, so what does that actually look like?
Well, don't think of traditional server racks. Think of highly advanced, liquid-cooled plug-and-play modules for AI systems. Because right now, hyperscalers need complete rack-scale platforms to run these new generation AI chips.
And those chips run insanely hot, right?
Oh, unbelievably hot. Traditional air cooling in a data center literally cannot dissipate the heat fast enough. The chips would just melt, or they'd throttle their performance to survive. So supermicrocomputer builds direct-to-chip liquid cooling infrastructure.
Meaning they can rapidly customize and deploy these massive AI clusters without those thermal bottlenecks.
Precisely, and the demand for that specific capability is just explosive. I mean, in their third quarter of fiscal year 2026, they printed over $10.2 billion in revenue.
$10 billion in one quarter. Wow.
Yeah, a 122.68% year-over-year surge. And their forward guidance is targeting roughly $40 billion for the year.
Okay, wait, 40 billion is phenomenal, but let me put my skeptic hat back on here because this is like running a marathon while bleeding cash.
That's a good way to put it.
Right. Looking at the financials, they have negative $6.8 billion in free cash flow. They are carrying $8.8 billion in debt, and their gross margins are sitting at a razor-thin 11.1%.
Yeah, the margins are tight.
Extremely tight. And management even said memory costs have basically tripled recently. So sure, they're selling a ton of hardware, but it's costing them an absolute fortune in working capital to build it.
And you just identified the exact reason for the recent crash. You can't just magically generate $40 billion in revenue without first buying the raw components.
You need the GPUs, the specialized memory.
The liquid cooling pumps, all that
Right.
copper, it requires an immense amount of upfront capital before a single dollar of revenue is ever recognized.
Which is exactly why we saw that $7 billion equity raise hit the market.
Exactly. The $7 billion financing, which was $5 billion underwritten and a $2 billion at-the-market program, is a necessary bridge.
And an at-the-market or ATM program, that's brutal for retail sentiment because they're basically just dripping shares into the open market over time, right?
Yeah, it creates a constant overhang of supply. It dilutes existing shareholders heavily, which is why the market hated it.
But given interest rates, they couldn't just take on more debt.
No, adding to that $8.8 billion debt pile would crush their free cash flow with interest payments. So they had to go to the equity markets to procure components and fulfill that massive $39 billion backlog.
Okay, so that gives us the business picture. They are diluting today to convert backlog into revenue tomorrow. Now let's move to the catalyst timeline. When do we actually see proof that this strategy is working?
The ultimate proving ground is going to be their Q4 fiscal year 2026 earnings. We expect those in late August or early September. The whole institutional market will be watching one thing: margin stabilization.
Because if margins improve even a little, it proves the scale is finally paying off.
Exactly. But beyond just earnings, they have major product deployments happening right now. They're launching the VR200 NVL72 rack, which is built on NVIDIA's Vera Rubin platform.
And that's crucial because Vera Rubin chips require even more power density, playing right into Supermicro's liquid cooling mode.
Right. And on top of that, they just secured a massive $2 billion AI infrastructure deal with Gorilla Technology in India.
Oh, wow. So expanding way beyond just the U.S. hyperscalers.
Yeah, into emerging markets, building sovereign AI.
Okay, so we have the earnings test, the new tech rollout, and international deals. But what else could move the needle speculatively? Because the stock feels so heavy right now.
Well, there are strong rumors that they might use part of that $7 billion to pay down some debt.
Wait, why do that if they need the cash for components?
Because paying down debt could trigger a credit rating upgrade. And that kind of corporate housekeeping often forces short sellers to mechanically adjust their risk models and cover positions. Also, any macro relief from a Fed pivot would be huge for them.
Right. Lower interest rates make their future cash flows mathematically more valuable.
Exactly. Catalysts tell us what could change the story. Now let's pivot to the chart, because none of those catalysts matter if the stock can't find a floor.
Yeah, let's look at the price structure, because the sell-off was structural.
It was violent. The stock bled from August highs of $47.91 down to a 52-week low of $19.48 before this recent crash to $29.27.
And the volume was insane, wasn't it?
Unbelievable volume. 184 million shares traded on the sell-off day. That is 316% above the three-month average.
184 million shares. I mean, that looks exactly like a climax of selling pressure. That's just extreme psychological panic, retail throwing in the towel.
Total capitulation.
Yeah.
And, navigating that extreme volatility is exactly why traders use tools with clean chart workflows, like VIP Algos, to map support zones like that critical $29 floor.
Because that floor is acting as a massive psychological level now.
Right. And seeing that massive volume gap down, but holding the $29 floor instead of going to zero, really implies a capitulation bottom.
So the chart gives us price structure, but what does market sentiment look like? Because a volume spike like that isn't just selling, it's a transfer of shares.
Exactly.
If retail is panic selling, who is buying? Because the headlines are screaming bearish right now.
Yeah, the narrative disconnect is the real aha moment here. While retail is panicking about dilution, 373 institutions have recently added positions.
Wait, really? 373?
Yes. We are seeing aggressive dip buying by major firms, including heavy hitters like Marshall Wace. Plus, there has been absolutely zero insider selling in the last 6 months.
That's huge. The executives see the daily order books and they aren't selling a single share.
Right. And regarding the analysts, their average target is still $37.62. They haven't fully modeled the new $39 billion backlog yet.
So the analysts are lagging the actual data.
Very much so. Once they factor in that backlog and the fresh capital, they are mechanically forced to raise their estimates.
That sentiment picture is super useful, but we still need to talk about the risks. because institutional confidence could be entirely misplaced if the core business fails.
Oh, absolutely. This is a very tightrope walk.
Let's lay out the absolute darkest bear case here. Let's call it the margin collision. What happens if that 11.1% gross margin continues to shrink due to component inflation?
If margins drop to, say, 8%, it's a disaster. The $7 billion raise won't just dilute existing shareholders. It will actively destroy shareholder value.
Right, they'd be building massive revenue that yields zero actual profit.
And if that happens, the entire bullish thesis breaks.
And then there's the governance and export control risk, which we cannot ignore. The DOJ investigation. Co-founder Wally Lau was charged with conspiring to smuggle $2.5 billion in servers to China.
Yeah, and that's not just a minor accounting error. That's national security.
Exactly. It carries the threat of massive penalties.
It does. I acknowledge the risks, but we have to balance the picture. The company is actively cooperating with authorities.
Well, they are.
Yes, they actually helped seize 50 of those servers and assisted in arresting 3 individuals. Most importantly, Super Microcomputer is not named as a defendant in that case.
So that softens the risk of getting a corporate death penalty, like an outright export ban.
Exactly. They're fixing their internal controls aggressively.
Okay, so with everything on the table, the massive backlog, the margin compression, the DOJ cloud, the capitulation volume, what is the final verdict?
The final verdict is a bullish score of 7 out of 10.
7 out of 10, okay.
Yes. We summarize this as speculative bullish. It's high risk, high reward. The main upside driver is that staggering $39 billion backlog that virtually guarantees a doubling of revenue. And it's trading at a cheap forward PE near 15.
But the risks are clearly the balance sheet mechanics and the margin pressure.
Right. The target horizon is a 6 to 12-month hold through the Q4 earnings cycle to verify if they can convert that backlog profitably.
And it's so important to remind everyone that this is strictly for risk-tolerant investors. It is not financial advice. You have to be prepared for volatility.
Absolutely.
You know, one final provocative thought before we wrap. If Supermicro is essentially the factory assembling these massive systems and they are getting squeezed on component costs, maybe the real play is looking one step further down the supply chain.
Oh, that's interesting.
Right. The companies making the specialized liquid pumps, the thermal manifolds, they don't have DOJ probes or massive dilution headlines, but they are supplying the picks and shovels for this exact infrastructure boom. Might be worth exploring.
That makes a lot of sense.
And if you want a cleaner way to read trading charts while you look into those secondary suppliers, check out VIP Algos through the link below in the description. It gives you visual buy and sell alerts, plus take profit and stop loss planning areas to help map out your trades. Just remember, it's an educational tool only, not financial advice. It doesn't guarantee results, and trading involves risk. It's an affiliate link, so we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.